it's always good to have certain other instruments that you're interested in trading. And one of those to consider is gold futures. What are these? They're just contracts, and they represent an agreement between two parties to buy or sell gold at a predetermined price on a specified date in the future. Right now, these contracts are going to allow you to speculate on the price of gold without you ever owning physical gold. But it's really important that if you're holding contracts at expiration, you get rid of them, right? You don't want to be holding those contracts when expiration date comes by. But let's talk about what moves gold. Gold is not just moving by supply and demand. We got various economic and geopolitical events across the globe that will influence the price. So if there's uncertainty or fear about the economic growth worldwide, maybe it's political instability or a pandemic like we all just went through, people tend to invest more in safe haven assets like gold. We talk about COVID, for example, gold prices surged to record highs. Traders just sought out safe haven assets, traders and investors, amid that economic disruption that was caused, not by the virus, by government reactions to it. So what are gold futures? Again, they're traded on a futures exchange, such as the Chicago Mercantile Exchange, the CME, and there's specific contract sizes and expiration dates. So one standard contract of gold futures is 100 troy ounces of gold. Micro gold futures, 10 troy ounces per contract. Now, each exchange is going to have its own set of rules regarding margin requirements and position limits that you're going to have to adhere to. So when you're choosing which future symbol to trade, you got to consider liquidity and volatility. You've got GC for the CME gold futures. You got CG for CME mini gold futures. You got QL for the NYMEX mini gold futures. There's other ones. Now, talk about trading hours on the CME from Sunday to Friday from 6 p.m. to 5 p.m. Eastern time. It's a daily break from that 5 to 6 p.m. So think almost 24 hours. When we talk about gold futures, we also have to consider CFD trading because it's two popular approaches for trading gold. So what's a CFD? It's a contract for difference. It's just a contract between a buyer and a seller where the difference in the asset's value at the time of opening and closing the trade is settled in cash. So let's compare them. Transparency, there's a high level of transparency with gold futures, a little bit less transparency with gold CFDs. Leverage, high leverage available in futures, high leverage available in gold CFDs. Liquidity, both pretty decent with liquidity. Trading costs for futures, a little bit cheaper than CFDs. Expiration dates, with futures, there's an expiration date. CFD, you can hold it a bit longer. Physical deliveries, hey, some futures contracts will require that. CFDs, it doesn't. Risk for futures, there's no counterparty risk. CFDs, well, there is a little bit of risk with that and a counterparty. Seasonal patterns, what do you got to know for that? Well, the demand for gold actually rises during the Indian wedding season, believe it or not, from October to February. Gold purchases are an important part of the wedding shopping experience in India. Believe this is incredible. The surge in demand for gold from India will often lead to higher prices globally. Although, again, there's other factors like interest rates and supply. That's quite impressive, actually. So we talk about technical strategies. When you use a technical approach, you get to understand how the market behaves, you can analyze charts and the patterns that you see. Then you form an opinion on what can happen in the coming days, weeks, or months. Place your trades in those directions. Now, to be honest, when you're trading gold futures, it's no different than learning how to trade any instrument. You just have to know a few of the details of the contracts. This is just a general overview. Let's talk about moving average crossovers. Very simple. So this strategy is just two different moving averages to identify when to buy or sell. First one, the moving average is calculated over a shorter period of time. I'm going to use a 20 SMA. The second MA is calculated over a longer period, just the 50 SMA. There are 4 steps to implementing this 20-50 strategy. You got to determine which time frame you want to use for each of the moving averages, right? If you have a shorter look back period, you're going to have more signals, but they could be less reliable, like a 9 and a 20. You put them both on your chart, wait for them to cross. When the shorter term average crosses above the longer one, it's a buy. When the opposite happens to the downside, it's a short. Got to use stop losses, got to limit your risk exposure all the time in trading, and monitor your trades close. That's a simple strategy, a moving average crossover. There's a slightly more advanced version of that, and that is just waiting for that price to go up for a buy, pull back to around the moving averages, and take a trade when that happens. We can use the RSI. Traders will typically look for 2 things, divergence from the trend and oversold and overbought. Divergence is when there's a difference between what the RSI is showing and what the price chart shows. So if gold prices is going up, but the RSI is trending downwards, that's divergence. Oversold, overbought is when an asset has been pushed too far down or up, especially on high volatility. These conditions suggest that either buying or selling pressure may soon reverse course, even momentarily. Here's a very simple 20 SMA and a 5-period RSI strategy. The RSI here is plotting higher swing lows, shows a bullish momentum. Price is put in a triple bottom. That confirms that the momentum shown with the RSI. Traders can then buy a break of that trend line. Price then pulled back. There's really no price pattern trend change at all here. No lower lows. And then we get a double bottom. The RSI is showing bullish momentum by a break of resistance. Now the setup, trade management, you got to have a full trade entry criteria. You got to have risk protocols, and you can flesh that all out. We have a lot of videos here on YouTube to look at. Talk about Bollinger Bands, 3 lines, a simple moving average in the middle, an upper band, and a lower band. So the SMA represents the average price of gold over a certain period of time, usually 20. The upper and lower bands are 2 standard deviations from this average. So when the price of gold moves outside these bands, this can indicate a change in trend or momentum. So you want to look for periods when volatility is low. This is probably the best way to do it. And prices are consolidating within a narrow range. We call it a Bollinger Band squeeze. You can see it. This often precedes a breakout or a reversal that could signal a really good entry or an exit point if you're in a trade. We have other indicators we can use. The moving average, convergence, divergence, the MACD. It's my favorite indicator. Measures momentum and the signals potential trend changes. All we're doing really is comparing 2 moving averages, a shorter period and a longer period, to identify momentum. When those MACD line crosses above or below a signal line, it suggests a buy or sell signal. But you have to require other variables for a trade, not just that. Support and resistance levels, it's the key of technical analysis. It's where buying pressure has been strong enough to prevent further declines, right? That's support. Resistance levels, this is where selling pressure has been strong enough to prevent further advances. So when you identify these levels, you can set your stop loss orders around them. You can set them as take profit targets, and you can look there for certain candlesticks and chart patterns. Pay attention to when you get out, as well as entry signals when you're putting your strategy together. And this means you got to have clear rules for when to close trades, when to get in trades. It's the only way to trade. And we want to talk about getting out of trades. Think of trailing stops. Think of profit targets based on a risk to reward ratio. Use multiple time frames to confirm trends. Let's talk about a day trading strategy for gold futures. And these are 3 popular trading strategies. Breakout trading. This is very simple. You can search YouTube on our channel here. This strategy, just buying or selling when the price of gold breaks out of a current range. Traders will then look for key levels of support and resistance to identify potential breakout points. Not that difficult. Trend following. This strategy, you have to identify the trend of the market in your specific time frame. Now, you really have to know your time frame when you're trading. Don't be flipping back and forth between all the different time frames out there. Be specific. So circling back here, trend following, you got to be patient. You got to show discipline because traders need to wait for a clear trend before entering trades. It's that simple. Scalping, taking advantage of small price movements throughout the day. You enter and you exit trades pretty quickly, often holding positions for a few minutes at a time. And you got to have a really quick execution platform. You don't want to be left hanging in a trade, not be able to get out when you want to. Now, the best day trading strategy, it's going to depend on you, your personal preferences, your risk tolerance. You got to develop a plan. You got to stick to it. But you also have to be flexible enough to adapt to changing market conditions. Like there's no way you're going to trade in the direction of a trend when it's going sideways. And that's going to get chopped to pieces. We're talking about price action trading. You got to study historical price patterns, obviously, identify trends, make predictions based on market behavior. And we talked about it earlier, support and resistance. This is key to price action trading. You need to find these zones where buyers and sellers have entered the market in larger numbers, creating a barrier that prevents further movement in that direction. Another useful strategy is candlestick pattern analysis. Candlesticks not bad. They provide information about price movements within a time period, like a 1 minute or 1 hour. And you can use this information to determine if there's a trend reversal occurring, which could then signal a potential buying or selling setup for you. So you got to understand what you see on the chart. You got to design your entire day trading gold strategy. You got to have all the variables in place. We can also trade gold through FOREX. And it's a very popular way to speculate. It's the XAU USD currency pair is usually the pair that people use. And there's the pros and cons for it. It's not a bad way to approach it. And actually with Forex, it can allow you to trade a lot of different things. You're not going to need the same amount of startup capital as you would with other ways of trading, such as options or futures. Wrapping it up, effective day trading strategies can make gold trading a lot easier than just guessing, believe it. By following tips that we talked about here in this video, you can minimize your risk, maximize returns, but you got to remember, always do your research. You got to stay disciplined. You got to keep a level head with the right mindset and the tools. Trading gold, not a bad, valuable addition to your investment portfolio or just something you want to trade.